Welcome back, Focus Learners. Today we're diving into an explainer on a company that's been on just a wild ride. We're talking about Netflix and their Q2 2026 earnings. Now, coming off a massive endorsement from billionaire investor Bill Ackman, you'd probably think Netflix was sitting on top of the world right now, right? And honestly, in a lot of ways, they are. But as we're going to see, the stock market is telling a completely different story.
Okay, so let's dive into this, because it's literally the central mystery we need to solve today. Wall Street has this really funny habit of punishing financial winners, and Netflix just experienced this firsthand. They posted what, on paper, looked like an absolute knockout quarter, yet the market just hammered the sell button. I mean, why does a massive earnings beat trigger a stock crash? To get into the psychology here, we've got to zoom out and look at where Netflix stock is actually sitting right now. Negative 40%. Yeah, that's the stark reality we're dealing with. Despite absolutely dominating the streaming wars, Netflix stock is down over 40% from its peak. It's a huge drop. So when this latest earnings report dropped, investors were already incredibly on edge, sensitive to literally any sign of weakness. They were demanding absolute perfection. And well, when they didn't get it, boom, the stock took another hit. Let's unpack what they actually saw in those numbers. Which brings us to part one of our explainer, a tale of two reactions to those Q2 2026 earnings. So on the surface, Netflix is still an absolute growth machine. Wall Street was expecting an earnings per share, or EPS, of 79 cents. But Netflix, they actually delivered 80 cents per share. That means net income climbed almost 9% to a massive $3.4 billion. And the top-line revenue? It came in at a rock-solid $12.56 billion. That's up 13.4% year over year. I mean, by basically all traditional metrics, this is exactly what you want to see as an investor. And this success isn't just happening at home. It's a truly global story. Latin America was the absolute star performer this quarter, surging with 21% revenue growth. That's massive. Then you've got the Asia-Pacific region jumping 16%, and Europe, the Middle East, and Africa growing by 14%. Even their core US and Canadian markets saw a 10% bump, though that was definitely helped along by those recent price hikes. So to recap, revenue is up, profit is up, they're beating expectations. It seriously looks like a home run. So the crucial point is, why the crash? Well, it all comes down to $12.86 billion. That was their revenue guidance for Q3. You see, investors are always looking ahead, right? And while Q2 was fantastic, the market was really hoping Netflix would forecast something closer to $13 billion for the next quarter. On top of that, they actually narrowed their full year 2026 revenue forecast just a tiny bit, down to between 51 and 51.4 billion. And that little gap, the difference between the 12.86 billion they guided for and the 13 billion the market wanted, that was literally all it took to send the stock tanking over 8% after hours. Wild, right? So let's move into part two. What exactly spooked the market? And what does the bear case actually look like? The skeptics out there, the bears, are essentially building their entire case on three key pillars: an engagement slowdown, margin pressures, and the harsh reality of lower overall growth. Look, Netflix is undeniably a mature business now. The days of them reporting, 20% plus subscriber growth quarter after quarter, those days are gone. In fact, they've actually stopped reporting subscriber numbers completely. And because the market is pricing this stock for absolute perfection, a mature, slower growth outlook is just the one thing Wall Street simply will not tolerate. Let's dig into that first major red flag: engagement. For the first half of the year, Netflix reported a record 97 billion viewing hours. Now, that sounds absolutely huge, right? But here's the catch. That's actually only a 2% increase from last year. It's a measurable slowdown. And to make matters worse, management just announced they're cutting back on releasing these engagement reports. They're going from twice a year to just once a year. They claim it's just to keep everyone focused on primary financial metrics like revenue. But honestly, analysts are super suspicious. They're wondering, is Netflix trying to hide a slowing core business by dialing back the transparency? Then we have this second big concern, which is margin pressure. The operating margin actually slipped a little bit, going from 34.1% in Q1 down to 33.4% in Q2. Management explained this away by saying content amortization growth was front-loaded in the first half of the year. But what does that mean in plain English? Basically, they're feeling the heavy, immediate financial weight of paying for their massive content slate right now. It takes a lot of cash to make all those shows. And even if this is just a temporary squeeze, it's a glaring reminder to investors of just how unbelievably expensive it is to maintain a dominant streaming library today. But hey, it's not all doom and gloom. Part 3, the bullish case still remains, and it's all about the long-term story. The bullish case for Netflix's big redemption rests on 3 entirely different pillars: a rapidly growing advertising engine, massive stock buybacks, and a complete expansion of their entertainment ecosystem. This right here is the master plan that the big institutional investors are actively betting on. Let's start with arguably the most exciting part of this new narrative: advertising. Netflix expects their ad revenue to roughly double, hitting an astounding $3 billion by 2026. They're heavily monetizing that new, cheaper ad tier. And their recent pivot into live sports, that's becoming a massive magnet for advertisers. We're not talking about some minor feature tweak here. This is a gigantic, brand new revenue stream, and it's literally only just getting started. Now, what's really interesting about this is the sheer amount of cash the company is generating right now. In this quarter alone, Netflix repurchased a record $4.7 billion of its own stock. Buybacks of this magnitude send a very clear message to the street. Management firmly believes their stock is undervalued, and they have the cold, hard cash to prove it. That provides a massive foundation of support for the stock price going forward. And hey, if $4.7 billion sounded like a lot, try to wrap your head around this. They still have a staggering $27.1 billion remaining in their buyback authorization. $27.1 billion. It just perfectly illustrates the sheer scale of Netflix's financial firepower. I mean, they are basically printing money right now, and they are absolutely not afraid to deploy it to prop up their share price through this turbulent period. But honestly, the most vital piece of the bull case requires us to completely reframe how we even think about this company. Netflix is no longer just a place to chill and watch movies and TV series. They are aggressively evolving their product to expand their total addressable market. Basically, they're transforming into this comprehensive, all-encompassing entertainment ecosystem designed to capture a much larger slice of your total daily screen time. A perfect example of this ecosystem expansion: gaming. Monthly active players on their cloud games are up an unbelievable 11 times since October. They are going straight after a $150 billion global gaming market. But they're not stopping there. To compete directly with the likes of TikTok and YouTube, Netflix is rolling out vertical video clips and podcasts right onto their platform. Co-CEO Greg Peters actually noted that this type of engagement is incremental, meaning, it captures your attention during your morning commute or on your lunch break. It's pulling you in entirely outside of those traditional sit-on-the-couch primetime viewing hours. So let's bring it all together for part 4, the final verdict, and why this is a classic show-me moment. Right now, Netflix is definitely facing a classic show-me moment. Look, the near-term headwinds, that slowing engagement, the margin pressures, the slightly cautious guidance, those are all very real issues. But, so is their valuation. Netflix is currently trading at around 23 times forward earnings, which actually happens to be one of its lowest multiples we've seen in years. So the market is essentially saying, okay, we see your big master plan, but we need to see the proof in the actual numbers before we start paying a premium for it again. So, for a lot of people, the long-term thesis for Netflix remains completely intact. They've got the scale, they've got the content, and they definitely have the data. The only real question for investors now is just how quickly they can successfully pivot into this massive new world of advertising and gaming. This could very well be a buy-the-dip moment for the long-term believers. So, looking at the entire landscape of media today and all the billions being spent, who do you think will ultimately win the battle for the future of entertainment?